So let's get this started. My name is Tila. I, as my lovely background shows, from Cake Equity. We're one of the leading platforms that help you manage your cap table, and we really help accelerate teams and motivate through equity ownership. And we're really excited to be chatting today to the panel. So we've got Isaac from Merton Lawyers, we've got Cody from Orrick, and we have our own COO, Charlie, from Cake. I'm going to hand over to these guys to introduce themselves, and then we'll kick off this conversation around flipping up to the US. We want this to be interactive. So if you do have any questions, please just pop them into the webinar chat and I'll jump in and add them to the list that we have to run through. But I'll hand over to you now, Isaac, if you want to go first with your intro.
Good morning, everybody. My name's Isaac Hanna. I am a senior associate at Merton Lawyers. I've been acting for the founders and investors of emerging growth companies across Australia now for about 7 years, working both with companies who are completely focused here in Australia, but also those who are expanding to the United States in particular, but overseas as sort of a general proposition there. In the past 12 months, acted on, I think, 5 or 6 different flip-ups and worked through those. And the thing that I can say on them is they're all different, but we can see some similarities. And chatting with Cody and Charles, that we do have some very similar experiences. So looking forward to this conversation.
Everybody, I'll go next. I'm Cody Peterson. I'm a partner at Orrick. We're one of the leading tech firms based in the US with offices all around the world. Before I came here about a year ago, I was a partner at Gunderson Detmer, another venture-focused law firm here in the US. I'm coming to you here from Los Angeles. I was just saying before, I think our weather is similar right now at 3 o'clock in the afternoon, despite the rest of the country being in snow. So it's great to connect with everybody. My practice is almost entirely focused on venture-backed startups and venture funds. I work with clients all over. Like I said, I'm based in LA, but work with a lot of venture funds based in Silicon Valley and New York. And I've worked with had the pleasure of working with a few companies that are based in Australia, including Cake. I'm going to be here to kind of come at this from like the US perspective of kind of what are you flipping into? What are the differences between an Australian company and a US company? And again, just want to reiterate, please feel free to drop questions in the chat, interrupt us. Sometimes these get jargony, and if there's anything that we're kind of assuming you already know that you don't, please don't hesitate to ask. So really just here to be helpful and looking forward to talking to everybody today.
Awesome. Hi, everyone. Charlie, COO at Cake. I am an ex-corporate lawyer, but I would say a very rusty corporate lawyer these days. So please direct all the corporate law questions to both Isaac and Cody for the purpose of this. But Cake itself did go through a flip up in 2021. So we can definitely speak to the challenges, the wins, what I definitely would have done different. And then what the experience is in life post flip up as well, starting as an Australian company and then really operating as if you're a US company. So yeah, look forward to sharing any horror stories that anyone wants, anything that I wish we'd done differently. And yeah, it's definitely any technical advice to get you through. Isaac and Cody are your people. And yeah, definitely want to reiterate that don't hesitate to ask any questions. There's lots of terminology throughout a lot of this that we may think is common knowledge, but it's definitely not, especially once we start talking about the ways that things work in the US. It is sometimes almost a different language. So feel free to comment in, and Tila will be keeping an eye out for any questions coming through.
Thanks. All right. So we'll kick off with the first question, which is, why would you flip to the US? Like, why flip up?
Yeah, I'm happy to start on that one from a US perspective. I think the simple answer, and look, you're talking to 2.5, 3 lawyers here. You're going to get a lot of it depends, and it varies based on circumstances. But I mean, the common perception that I have is that if a founder and a management team believe that it's in their best interest to raise money from US investors, then you probably want to consider flipping often when you're going through that first price round. And so, there's a lot of caveats there. We'll kind of talk through the mechanics. But I think it probably goes without saying, for better or worse, that a lot of the US or a lot of the venture capital around the world is located in the US. And so this is changing over time, and it's not true for every venture fund that I work with or have worked across from. But a lot of US-based investors will want you to be a US and most likely a Delaware corporation before investing. And so it is often kind of thinking about it in terms of when you're going out and having those conversations that's the right time to do it. But as we were kind of having our pre-read on this, I think Isaac and I probably have slightly different perspectives on this. And so Isaac, I'm curious to hear kind of how you counsel founders who are based in Australia on whether it makes sense and when might be the right time.
Yeah, look, I think, again, I'm a lawyer. We're going to say it depends a lot today, Cody, which is just reality. And every company and every founder is so far different. And what we need to be looking at is, when does it make sense? And so for some founders, it will never make sense. What they need to be looking at is, do they have a need for a footprint in the US? Are they going to have people on the ground in the US? Are they going to be moving to the US? Because we need to ensure that once we have a US company on the ground, that the control of the operations of that company are entirely located, as in at a corporate level, in the US for tax purposes, because we don't want dual taxation risks. We need to make sure that it makes sense from a tax perspective for you and your primary investors as well. And so it's all of these different mechanics there. And the thing that I will say is that we are seeing a lot more investment these days, especially growing over the past 5 years, from US investors into Australia. And I think that's just a coming of age post-COVID sort of situation for the Australian ecosystem, which has been really exciting to see. But at the same time, there are concerns from US investors around the tax treatment of proprietary limited companies. Is it going to be a passive foreign investment company, or PFIC? And I'm sure Cody can talk to that in marginally more detail than I can. But those considerations for those investors are really important. The other thing is, keeping in mind that Australian owned is really important to a lot of Australians. So if your primary market is Australia for your customers, flipping up to a US company probably doesn't make a huge amount of sense.
Yeah, and I'm coming at that from a slightly different angle. Sorry, Charlie. One quick point here. I was to say, just thinking through, I mean, I analogize this a lot to founders that I work with who are based in the US who might have started as an LLC, for example. Probably not familiar with that. It's a different corporate structure. But oftentimes, when I'm kind of guiding those founders through those questions of when do I flip, there's a lot of less legal and just kind of practical conversations to be had. And so I think more than anything else, and hopefully one of the big takeaways of this conversation is for all the founders listening here to be kind of armed with the information you need on, have you made that decision, when you expect to make that decision. And so again, kind of analogizing to the LLC conversation in the US, I'm often telling founders hey, if you go into an investor meeting and you tell them you're an LLC, they might look at you funny and say, hey, do you not know what you're doing here? And why did you set it up that way? I don't think that's the case, and Isaac and Charlie, correct me if you disagree here. I don't think that's the case for an Australian company. There are very legitimate reasons to stay as an Australian company, and there are good reasons to flip. I would say that you should not be flipping just because you think it's going to make you more attractive to a US investor, and certainly don't need to do it preemptively for that reason. As Isaac said, more US investors are getting comfortable investing in Australian companies. Again, in the US, we're using a Delaware corporation because the corporation basically stops the flow of tax. There's not tax passed through to the venture fund, and honestly, more importantly, through to the limited partners, basically the investors in the venture fund. But that's not true for every single venture fund, and every fund is slightly different. So I think more than anything else, you don't want to be wasting money paying lawyers like me to do things that maybe aren't actually necessary or might not be in your interest in the long run.
Yeah, totally agree. Totally agree. I think in Kate's situation, we did flip once we were requested to flip by a US investor. So we didn't do it preemptively. It was based on a request. So maybe my advice for founders and operators out there is definitely don't do it preemptively, thinking that that's going to just make you attractive to a US investor. Sometimes they expect it, sometimes they don't. But do get your ducks in a row in case you find the right investor that does want it, so that when you then go to do it, you don't take 6 to 12 months doing it and the investor goes cold. So, we'll probably get to this later on, but things like a clean cap table, making sure you've got contact with all of your shareholders, your stakeholders, understanding what your board structure is and all of that is worthwhile organizing now if you think it's a possibility. Pick your right advisors so that if you do get an investor that says, hey, I'll invest X dollars, but you need to be Delaware C Corp, but I need to close this in the next 3 months, you can call your lawyer and say, hey, let's go. But yeah, in our situation, it was a requirement that we're a Delaware C Corp, and there's been many positives off the back of that. But what I would have done differently is learned more about it prior to that happening to make it happen a little bit faster in retrospect.
I feel like we've kind of already touched a little bit on some of the common reasons founders may be doing it a bit too early or unnecessary around in thinking that it's going to mean that they're going to secure investment. Is there any other things that you are seeing where, maybe founders are unnecessarily starting the flip up process or flip, or maybe they do it too early?
Yeah, I mean, I see a lot of people think that they need to do it before they're having those conversations with investors, and the investors saying this is a requirement. I think it's really smart to have the conversation with your legal, your tax advisors, your corporate advisory groups, etc., to ensure that you're in a position that when you go into these conversations with potential investors, that you can practically achieve the flip up, that this is actually something that you can go in there and say, yeah, we can flip up. We've got the advice. We know that how this is going to be treated. We know how the process. We understand the process. And I think that's probably something we should talk about in a moment, is what is a flip up and how does it actually procedurally work. But we need to get those ducks in a row early, but don't pull the trigger on the legal costs and the incorporating companies, and make sure you understand how all of these things work as early as possible, but have a plan for why you're going to do it. So we're going to do this because the US or whatever foreign jurisdiction, but in this instance, the US is our future market. That's where our investors are. That's where our ultimate exit position is going to be. That's where we're going to list, is in the US, and make sure that that's all part of the long-term strategy.
Isaac, I'm not sure if you ever see this, but I wonder as well. So in Australia, we know that there's the cap on private shareholders for a private company, 50 shareholders. Outside of that, with some flex, you have to become a public company and everything becomes a bit more complicated. In the States, there's not such a strict limit. Do you ever see companies flipping, not just for the investor reason, but because they're approaching that 50 shareholder limit and they want to take advantage of the larger flexibility in a Delaware C Corp?
I haven't, but I don't know if it is actually more flexible in that regard, because there are other strategies you can put in place in Australia to minimise that. So whether you're going to become a US C Corp or sorry, a Delaware C Corp, or stay and become a public unlisted company in Australia, as I'm sure you've experienced, Charlie, there's a really big increase in the amount of corporate governance that you have to do in the US, or probably not an increase, but a change in the corporate governance that you've got to comply with. And so whether there's a cost saving by doing it or whatever, I don't know. I have never balanced that. Yeah.
Yeah, cool. I think from our side it was a perk of it, but it wasn't the reason. It was an extra perk that came along with it, that we weren't burdened with that 50 shareholder limit. But in saying that, to any founders listening, I would recommend trying to avoid getting to that 50 number regardless, because it will make the flip up far easier if and when you get there.
Yeah, you hit the nail on the head, Charlie. I was just going to say, look, this sounds very self-serving, but all your founders, you have a million other more pressing things to deal with than legal. And so having somebody like Isaac in your corner early on, where you just know, hey, what are the things I need to be looking out for in the case that I might want to flip in the future? And like Charlie said, either whether it's a legal question or not, having 45 stockholders is going to make the process much more complex, whether you're flipping for the reasons we're talking about here or not. And so I always tell founders that I work with, and this is usually post-flip, of my job is to make sure that legal is never the reason you don't get funded or don't get acquired in the future. And so having somebody in your corner early, both from a legal and an accounting perspective, even if you're not thinking about this, but just knowing that you've got the peace of mind, hey, this might be a thing I need to do in the future. And so make sure we don't accidentally make it a lot harder on ourselves, and honestly, a lot more expensive on ourselves, by doing some things that are going to make the process much more difficult in the future.
And just to give some context on that 50 cap that we're talking about, in case there's anyone on the call that's not familiar with that, Isaac, or Charlie, do you want to give some clarity on what you're meaning by 50 cap?
Yeah, perfect. So in Australia, to remain a proprietary limited company, you must have 50 or fewer than 50 non-employee, non-crowdsource funded shareholders. So your employee shareholders and your CSF shareholders don't count for that cap. But if you exceed that 50 number, you have to convert to a public unlisted company. That increases all of your compliance costs. You've got to start having audits done at certain points in time. You've got to have 3 directors sitting on your board. Most people do have 3 directors, but it's still a requirement. And there's a whole host of additional reporting that you've got to provide. It also, once you flip over to that, flip over to being a public unlisted, everything becomes more complicated. Everything becomes slower. So with the other options that you have, we can use things such as bare trust arrangements to reduce the number of shareholders sitting on your actual cap table or sitting on your member register. That's all well and good, but again, as Charlie and Cody have said, the more stakeholders you have, the more complicated any sort of future flip up is going to be. And we are going to be in a position where what we have to do is negotiate with a lot more people to get things done. And there is always a recalcitrant shareholder. It just does not matter what company. You can have 6 people on your cap table, you will have a recalcitrant shareholder. So we need to manage those people early and manage them often.
Except for Cake. I will gladly say Cake was the exception to the rule, where we were amazed, but all of our shareholders were really supportive. And I won't tell you the number, but we did have quite a few stakeholders, to the extent that our advisor at the time said, don't do this flip. You need 100% of the signatures. They told us, don't do this. You'll never get all of the signatures. People might be away. People might have changed their email. But luckily, our founders had always kept in really close contact with our investors, consistently over the years. So we did have all of their updated contact details, and they were all great supporters. So we were able to start that communication cycle before we needed those signatures, which saved us. Because otherwise, if you only start asking them for signatures when you need them, it allows 6 months before you get them to come back.
I think that's really good general advice. Keep in touch with your investors at all times. Keep them up to date. Keep them up to date with what you're doing, what the future path looks like. Give them the shareholder updates, even if you're not required to, because they appreciate it. They feel like they're along for the journey, and it will make things like a flip up a lot easier for you, and all sorts of other corporate actions, but a flip up especially.
Couldn't agree more. Sorry,
sorry.
I'm just going to maybe ask a question for Charlie and Isaac. I mean, I've not encountered this personally, but is there any reason why an Australian-based investor would be opposed to a flip? Is there any benefit in kind of like giving them the heads up early on in case it might be an issue down the road?
There realistically isn't in my view, there isn't a major downside for most investors in Australia. There could be some tax treatment questions for individual taxpayers in Australia. So that is one thing that you need to be really mindful of, is that everyone has different structures and everyone's invested in different ways to ensure that they have the right tax treatment. So and I'm not able to give any sort of like really clear guidance for all structures, but if somebody's invested through a self-managed super fund, it will be treated differently to if they've invested through some sort of unit trust structure. And you need to make sure that people are comfortable and have that opportunity to go and get individual tax advice on the situation. Even though we'll design things so that it works, we can't account for every scenario. So it would only be a problem, I think, if there was going to be an adverse tax impact.
Yeah, that makes sense. In my experience, whether someone's recalcitrant or just on a yacht somewhere, like the idea of doing this instead of financing is usually good news. And so there is a herding cats element to it. But yeah, there's always one person that's difficult for whatever reason it is, even if they're not actually opposed to the transaction itself.
Yeah, and I think that's a good point, Cody, in that often flips are done in conjunction with the financing, or with the raise, as many call it in Australia. So one thing which can be an issue with individual investors might not necessarily be the change in tax structure from going to the Australian to US, but the change in the governance that will come along with it. You'll tear up your shareholders agreement and essentially recreate those rules in the US. And that often results in different rights and privileges for those shareholders. So they rightly will want to review that and understand if and why their shareholder rights are being diminished, if that is the case. Often it is because the standards are different. So that's often a reason why shareholders justifiably do want to slow down and read it properly to understand what's happening, to make sure that they're not going to be crazily diluted without the same permissions that they had before.
All right, I'm going to interrupt now before you guys keep going. We've had a question come through the chat, and it is so-called large proprietary companies in Australia have to have a financial audit. There's no similar requirement for C Corp in US, right? Question mark.
It depends, but no, there is not a directly comparable requirement, though. Isaac, you mentioned crowdfunding earlier, and I hope my face didn't give away my just immediate response. That look, I personally think that crowdfunding is a fantastic thing, and that we should democratize access to capital, particularly for early stage, often overlooked, underrepresented founders in the U.S. But the reality is that crowdfunding has often been kind of a flag of somebody that struggled to fundraise, and it's very, very hard to go from a crowdfunded company in the US to one that is venture backed. But I say that also in part because there are some crowdfunding specific regulations that sound like they operate very similar to what you guys are describing in terms of financial audit and effectively becoming a public company much, much earlier than anybody usually wants to be a public company in terms of reporting requirements. And so generally speaking, I've not seen this become an issue for Australian companies that are flipping to the US for a variety of reasons. There usually isn't an immediate reporting requirement along those lines. There could be, depending on how many US-based stockholders you have and whether or not they are an accredited investor, which is kind of a defined term. Generally speaking, meaning somebody that's relatively wealthy. The thresholds are $1 million in assets, not counting a primary residence, and or $200,000 in salary for each of the last 2 years. Usually, if the people receiving equity are kind of meeting those thresholds, then there aren't reporting requirements. But a long way of saying, typically, no, there are not similar requirements, but you can, on some edge cases, run into scenarios where you might have some issues if you do have a larger cap table than most companies do at this stage.
How about Cody? One thing that I found interesting and surprising going from Australia to the US was, in Australia, you're required, even as a private company, to update ASIC, our corporate regulator, with changes in shareholders. And, at least it doesn't extend to option holders, but very specifically within 28 days, any change to addresses, names, holdings. In US and Delaware, it feels far more relaxed on that front, that once you lodge your documents, it's okay.
Yeah, it's rich. You'll hear US politicians talk about, Cayman Islands and things like that as being shady offshore places where, anonymous funds can flow through. But yeah, there is very, very little public reporting requirements for a Delaware corporation. Stockholders, directors, and things like that are not publicly searchable. There is a charter that is on file, and oftentimes the pitch books of the world are kind of aggregating data from that charter to maybe kind of back into like, hey, what do we think the valuation of the last round was? But beyond that, the only annual reporting requirement is an annual franchise tax that is due in Delaware. And then if you end up with operations in California, for example, you might have a similar filing in California. But yeah, there's very limited information. You'll have a registered agent that is one of usually a few dozen companies that will be kind of the public contact. But yeah, there's not even usually a founder or director officer who's required to be listed and with contact information available. So yeah, it can be very, very anonymous compared to what I understand of basically an opposite approach for Australian companies.
Yeah, a publicly searchable register of directors and shareholders. So I found that doing the first few flip ups that I did, really explaining that to people was very difficult for them to understand, that there's no ASIC extract or equivalent of an ASIC extract to show them what's occurring. Well, essentially, you've got a Word document that says you own shares in this company, and that's your lot, and a stock certificate or something similar. It looks very fancy, but other than that is just a DocuSign. So that's definitely I'd say a mindset barrier for a lot of people, especially groups who do not understand how a US company is sort of structured. And that's one of those communication pieces that you as founders need to go out and have with your, I suppose, less sophisticated investors. And when I say sophisticated investor, I don't mean a person who meets the Corporations Act description of sophisticated investor. I mean somebody who just does not do this on a day-to-day basis. So your venture capital groups, they're going to be pretty chill about it most of the time. Any sort of institutional investor or similar, family offices will be fairly relaxed about it, but it's when it comes to your mum and dad or your SMSF investor that's come along at some point, and some of your angels who will be a little bit more needing their hand held. Not a problem, just brought along for the journey.
And I'll give a shameless plug here. I mean, being on a cap table platform like Cake before and after, it can really simplify that process too, where the explanation is like, look, you're going to be able to log in and see your holdings in a very similar way. But yeah, ultimately that is the only way of knowing your holdings for most US based companies. So, and there's also a lot of good resources on the Cake website similarly to kind of see like, what does it mean to be a US stockholder and things like that. So certainly kind of being armed with the resources available to really handhold some of the people that might not fully understand what this means and why it's happening, and you maybe aren't fully comfortable or haven't done it before. But yeah, I completely agree with Isaac. The typical venture investors and even some of the angels are probably going to be familiar with this. Oftentimes, it's much more if you have a few employees or the friends and family around that aren't fully up to speed and might have a lot more questions. And it's easy for me to say, but it's one of the reasons why I'm often advising founders like, hey, that $5,000 check from a friend or family member might be a lot more expensive in the long run, because it's one, a higher percentage of their savings, and two, like you're going to feel pretty obligated to hold their hand and answer those questions that they have when you're going through processes like this one.
Excellent. I think that's a good segue into my next question, which is, okay, I've made the decision, like I'm going to flip up. What do I do now if I'm the founder? What's next? What's the process?
First step, come and speak to your lawyer and your accountant. The most important thing is to start getting your tax advice in a position where you can present it to your shareholders, so that you have got that pathway to ensuring that you are going to obtain the capital gains tax rollover relief, which you require in order to make this attractive to Australian taxpayers. The second thing is to make sure that you understand what documentation you're going to have in place. Get your legal team, if they've not previously worked on your company, across all of your documentation, so that they know, hey, you've got these shareholders agreements. I had one last year where the client said, "Oh, we've got a couple of safe notes," and it turned out there were 46 safe notes. So right, like we need to know all of this background information, and if we don't have that background information, it just balloons the process. So getting in early, getting all the documentation together is really important. Products like Cake, fantastic. If you come to me and say, all of my shareholders, all of my ESOP, all of my convertible notes are sitting in Cake, that is exactly what I need to see, because if I get a spreadsheet and it is all over the place, it is just going to be a nightmare for me to work through it. So getting all of your presumably you're doing this as part of a capital raise, so a lot of things should already be in sort of a really good condition, but a lot of people, they're just not. And so keeping all of your documents in one place, making sure that all of these things are really easily accessible and that you've been communicating to people along the way is just so critical. Once we've done that, we need to get some US lawyers on board. We get Cody and we start talking to them about, one, is Delaware where we want to go? And I'm sure Cody's got some views on that. Two, what documents are we going to have to put in place for the US? And then three, how does this actually work? What is a flip up? So for I suppose argument's sake, a flip up is a top hat restructure. The shareholders in your holding company transfer their shares to the new Delaware C Corp, typically a Delaware C Corp. And in exchange, they are issued shares in that Delaware C Corp, or stock in that Delaware C Corp. That stock will be in equivalent proportions. So if you own 30%, you'll own 30%, and it will be of the same or as close as possible class of stock, so that you retain the same underlying share rights between the two entities. And that's really important for your CGT rollover relief that you'll be getting. Once that's sort of done, it's really over to the US guys, and they put everything together, and we go and get all the signatures on the paperwork. Cody, you've
Yeah, thanks for setting that up. And again, I'm coming at this from the perspective of this is almost always done in connection with a raise. And usually, I mean, certainly it's your first price round, meaning this is not a safe financing in a US company. It is much, almost always a Series seed or whatever you want to call it. And like Isaac said, so you're kind of running that reincorporation flip process usually at the same time while you're negotiating the financing terms with your lead investor. And so not to get into financing 101, but hopefully you've got a term sheet from a lead investor, somebody who's reputable that you're excited to work with. I usually work with that investor's counsel directly in negotiating all of the NVCA style, that's the National Venture Capital Association kind of form documents. And at the same time, we're kind of setting that flip to basically happen immediately prior to the closing of that financing. And so in practice, that means we're doing all of it at the same time. But you can imagine how basically we're making sure that flip is done immediately before then the new investors can invest directly in the new corporation going forward. You alluded to it, Isaac. It's still it's almost always going to be a Delaware C corp. There are a lot of reasons why that is the case. There's been a little bit of publicity in the last year or so of some prominent companies moving out of Delaware, and a few venture funds in the U.S. even suggesting looking at places like Nevada or Texas as alternative jurisdictions. In my experience, and I still think this is kind of the right answer for virtually all the founders that I work with, particularly at an early stage. Delaware is almost always the right answer. And that is more than anything else from a legal perspective. It's because there are decades of case law, there's certainty. And so, still, the great majority of US based venture investors want you to be in Delaware because they know their rights. They're kind of comfortable with all the provisions that have been in the NVCA documents for decades now. And there is just legal certainty. And also, there's a practical benefit here. Delaware has built out kind of corporate chancery courts very specific for this corporate process. And they also have a really good filing team to make sure that when you need to file a charter on short notice, you can do that quickly. I fortunately don't usually work with California corporations, but like even just the filing process is night and day difference. Where if you want to file something in California, unless you expedite it, it usually takes 2 or 3 weeks to get back. Delaware, it's usually 2 or 3 days with the option to pay a little bit more to get filings back in an hour or 2 hours. And so it sounds pretty boring, but like it's basically infrastructure is the reason why Delaware is the place where 95% plus, if not even higher, 99% plus of US venture-backed companies are still located. But yeah, beyond that, it's a lot that goes into the financing. You're going to negotiate a term sheet. There's a lot that we can kind of get through in more detail at another time, but usually this process is happening simultaneously. And so as you're negotiating kind of everything that's going on, you're also going and herding cats and collecting signatures. And again, more than anything else, communicating with the people that you know that you're going to need to get signatures and kind of get everything done, because this is a lot going on, and hopefully you've got good people in your corner to kind of negotiate and guide you through that process.
Yeah, well, one thing, Cody, that was really interesting for me, and even coming as an ex-lawyer, was how different the US corporate documents are to Australia. So in Australia,
Yeah.
you basically have your shareholders agreement, which, in most cases overrides the constitution. Might be a 30 to 50 page document often. And to be honest, the shareholders agreement is like a picture book compared to what you're going to expect in the US. The US
Yep.
splits that shareholders agreement up over what Cody referred to as the NVCA. So it's basically 4 documents that split all those different parts of the shareholders agreement out. And even as someone legally trained, it was quite hard to get my head around. So having a lawyer in the US that can talk you through what it all means and compare it to the same provision in your old shareholders agreement, which will be torn up and redrafted in the US form, is super helpful, especially if you are negotiating with a US investor that knows these NVCA documents front to back. You need your lawyer with you on that call before you start negotiating the terms, or it can really shoot you in the foot.
Yeah, I couldn't agree more. It's a lot, and I even in non-flip scenarios, I always feel bad because a founder says, "Hey, I've got a signed term sheet. When are we going to close?" And it's like, well, it's probably going to be 4 to 6 weeks, because you take that 2-page term sheet and it turns into tens, dozens, over 100 pages of longer contracts that really cover the same points, but in a lot more detail and get heavily negotiated and everything else. So yeah, look, hopefully one of the takeaways is have a good lawyer in your corner, but certainly as you're going out and doing a price round, you need, in my mind, it's one of 4 or 5 US based firms that do venture financings constantly, day to day. I would say what I do is not rocket science, but just kind of having the data points to know, like, hey, this is how it normally goes. If we are going to deviate from one of the kind of normal provisions, let's think about the impacts of that. Certainly from a founder perspective, it's pretty easy to negotiate valuation and everything else, but you want to get into the nitty gritty of like, who controls the board? Is there a scenario where I might be removed from the board? When do I have to go get stockholder approval for things that I might not have needed stockholder approval for previously? And so really getting into the weeds of like, how much control are you giving up? And like, what does that mean going forward after this deal closes?
Just before we dive a little bit more into like, you've mentioned like this shareholder agreement and stuff changes, and I want to dive more into like what other sort of structural things that we sort of talked about in our prep for this call. But the other two bits that I have around this, like what is involved question is like, and I feel like I'm preempting very much a it depends answer. But what I'm looking for here is like, how long does this process take? Would be the first one.
It depends.
Didn't
Essentially,
disappoint, thanks, Isaac.
yeah, didn't disappoint. No, look, what it really depends upon is the number of shareholders that you have in your Australian company. I think really dictates how long this will take. If you are a sole shareholder, sole director, and you've got this great little business and it's time to flip it up, it could be a week, right? Like it literally comes down to how long does it take you to file the charter in the US. Because but the longer you've been around, the more shareholders you've got, the more complexity you've got sitting there in the company. Have you got intellectual property? Have you got intellectual property here in Australia? Have you been developing it in the US? You have a US subsidiary? Have you got Australian operating subsidiaries? What are you doing with the R&D tax incentives? How's that working? How many employees do you have? What are we going to do with the employees? Have you got ESOP? Have you got safe notes? Have you got convertible notes? Have you got debt? What's happening with the lease for your premises? Do we need to get a change of control from the landlord? So it's a whole host of. It really depends on each individual company, what your structure is, and how complicated you've allowed your company to become before embarking on this process. My ideal would be a handful, 10 shareholders maximum, who are really committed, on board, they're ready to go. You've been in really good communication with them. Minimal ESOP allocations out there still, because the ESOP allocations it's just another thing to deal with, and we don't want to put them on the back burner and deal with it later, because that will be an issue as well. We also want to make sure that we've got as few alternative financing structures in place. So if everyone's on a convertible note, do we convert them prior to, is this like something they want to be converted on? Do we convert them prior to flipping up? Do we need to recreate their convertible note into the US company? What are we going to do about all of these things? So, yes, it is, and it depends. And I think the simpler you are, the quicker it is. The simpler you are, the cheaper it is. But it is not a process that you can cheap out on. This is a process that you need to be ready to spend money on. You need to be able to have the focus on it. Keeping in mind that you're going to be doing it at the same time as probably raising capital in the US. So it will actually absorb your entire life as a founder.
Yeah,
I can.
and oh,
You
sorry.
go, Tila.
No, I was going to ask another question. So if you have something to add to that, Charlie, go for it.
Oh, yeah, I was just going to give our raw experience. It was about 6 months. And I won't give you the dollar figure. If anyone wants to message me privately and talk about the costs, wasn't with any lawyers on this call, by the way. This was prior to meeting Cody. But the reason it took 6 months for us was we did have a high number of stakeholders. It was in conjunction with the capital raising round where additional investors wanted to jump on that round bit by bit. So when you think you have all the terms agreed, then another investor wants to join in, and which was a great problem to have. And we did sort of structure it as a bit of a corporate cleanup at the same time. So we took a few extra steps around the basic flip up stuff, which made it take a bit longer and made it a bit more expensive, but was all well worthwhile doing that early on before things became more complicated.
Yeah, well said, Charlie. I think you laid out the maybe kind of extreme, like how do things get a little more expensive when it's kind of drips and drabs and it's a lot of investors. I probably should have shared this earlier. I'll post a link in the chat here, but this is an article from about 3 or 4 years ago that a colleague of mine at Orrick wrote, and I kind of shudder a little bit because in this it says like on the low end it could be an extra $10,000 to $15,000 US in connection with the financing. On the higher end, it could be $50,000 plus in addition to whatever the financing costs are. And I saw one of the questions is like, can you kind of include this in the financing? And then the tricky part is that it's almost the opposite. One of the terms you'll see from a US-based investor is often that there is a legal fee reimbursement for investors' counsel. And so not only are you paying for your own lawyers, you are often covering the cost of your investors' lawyers as well. And so I usually kind of guide, and this is not a hard and fast rule, but for a Series seed financing, you're probably going to see an investor fee cap somewhere in like the $30,000 to $40,000 US range. And oftentimes your company counsel's fees are about double that because company counsel is doing all the drafting of the documents, leading this kind of herding cat process. And so as a rough estimate, I'm telling kind of like even non-flip US based Series C first price round, you're probably budgeting around $100,000, if not a little bit more for total legal fees. And so the amount in addition, when you're talking about doing a flip, is then heavily dependent on all the things we're talking about here. And so you can kind of back into the math here where like, ideally this is being done in a $3 million or more, like, really legitimate first price round. And then, it does sound really expensive, but those fees don't scale the same way that a Series A, a Series B, Series C does. So if you go and raise 25 million in a Series A, legal fees are not going up 10x, they're probably going up 25% or 50% or something along those lines. And so it's a really hard balance. It's honestly one of the hardest things I deal with in my job is that like, hey, it's really, really worth it long term to get everything right now. And like Charlie said, like oftentimes the Series seed financing with a good investor is a very collaborative, like, hey, we're all aligned here. Let's make sure everything's cleaned up. If we need to go chase down a couple of people to sign IP ownership agreements, or like, hey, we didn't quite document that equity grant the right way, let's get it fixed now. That's the time to do it. It adds to that cost in that round, but then it should, in theory, kind of make everything a little bit easier and a little less expensive, relatively speaking, in the long run.
And so you're looking at those fees on both sides. So like you've got your AU, we've talked about having the AU like legal team, just to sort of really nut into the cost and the budget. So like are you paying like obviously a set price or like, not set price, but you're paying for your Australian legal team and then also on top of that, the US legal team is what we're saying.
Yeah, that's correct. There'll be Australian legal. You'll have Australian tax advice as well. So those will generally be two separate components. With respect to fees themselves, you can do it very, very affordably if you do it early. If you've got that very small number, no complexity, etc., it is quite straightforward, quite reasonably priced. Australian legal costs are nowhere near what US legal costs are. I would, yeah. And Cody's talking US dollars there as well. So, add another sort of 40, 50, 60% to that in your conversion to Australian dollars.
Which is something to consider when flipping as well, is that will be
Yeah.
then your continuous costs going forward.
Yeah. And US, yeah, I mean, all power to them. So, they need to be able to cover that. And so it is an expensive process, and that's why getting it right and getting the timing right is really important. And being prepared, because the ill prepared is where the costs really balloon.
And find lawyers that like working together on both sides, I find useful. For example, if the lawyers already know each other and they know how the US counterpart works with the Australian counterpart, that's really helpful because you don't want to end up the middle person trying to negotiate what the US lawyer told you to the AU lawyer, because your costs will just skyrocket and it will be lost in translation. Find lawyers that work well together and have previous contact is always worthwhile.
Couldn't agree more. And yeah, and to me, that always comes down to just like finding lawyers that have done this before. And there are ways to do some research there. There are a lot of people that hold themselves out as startup lawyers, but haven't actually done this process before. And so, again, there are a handful of firms here. You're going to find somebody that's done it well. And hopefully people should be able to get along and be incentivized to get this done as efficiently as possible.
Yeah, excellent. And we've sort of touched on CSF and like, having large numbers of stakeholders on the cap table. One question I had was like, where do syndicates fit in that? Like if you've come through, like I sort of mentioned a little bit about the family, friends, fools round, like that early stage stuff. Like, do syndicates, like, do they make things more complicated? Does that have any impact?
It could, but generally you would manage that through your shareholders agreement or how their shareholding as a syndicate is operating. So if you are keeping them nicely syndicated as one person sort of sitting as your syndicate, and you've got processes in place from early on for how to deal with them, it shouldn't be any more complicated. But where you've got 400 CSF shareholders, that's a nightmare. So working out how to deal with that will be a very, very big decision. And I think that you would probably go down a scheme of arrangement process for which is a court-led Corporations Act process for a CSF company, if you were going to even bother trying. And that would be phenomenally expensive.
Isaac and Cody, correct me if I'm wrong, but one big difference I think in the flip up in conjunction with the raise is often if you're just raising, your shareholders agreement or your MVCA documents stipulate that you only need certain shareholders' approval to do that, and you can make changes without requiring signatures from everybody. Otherwise, you would just be in handcuffs the whole time for making any changes, and you'd never get anything done. However, when you're flipping, most of the time you will require 100% of shareholders, even from that person you mentioned that had that $5,000 check early on. And that's the difference, is you're suddenly doing a raise that you need everyone to agree to, which can make it more complicated.
Yeah, and hopefully this is
Definitely.
the last time you have to do that, because like you said, Charlie, going forward, and that'll be one of the provisions that's negotiated, but typically you set a threshold if it's a majority of preferred stockholders or something along those lines for all amendments in the future. And so I do think me kind of bringing this conversation full circle, it's can be one of the points where a smaller investor might not feel totally comfortable because they're going like, this is their last chance to have any influence on what the terms of the financing agreements are, because going forward, you won't have to get their signature at all for the next round of financing or potentially even for the acquisition. And so it is a pretty unique moment in time where you have to go and get every single individual stakeholder's signature. But once that's done, going forward, you try to set a threshold where it might just be your one largest or potentially two of your largest investors to go get the approval at your Series A. And that's often why sometimes the next round of financing can be a lot easier, because it's just the people who are already around the table. You're not going and chasing signatures and trying to get every single stockholder to sign off on a document.
Having said that, we are definitely seeing a lot more flip up or top hat restructure provisions in shareholders agreements, even at quite an early stage in Australia. So, I mean, following some of our experiences, we've put that process in place in our own precedent shareholders agreement. And what that's there to do is to manage those $5,000 check holders, those 1%ers, and we can essentially force them to the table rather than having to get their I suppose clear consent. It's very much, well, you've already agreed that we can do this, and provided that the founders agree and your major Australian investor agrees, then we can proceed with this process, much the same as we could drag along a minority shareholder in a transaction.
Excellent. All right. So we're conscious we've got about 12 minutes left. So if anyone in the webinar right now live has burning questions, please, this is your time to put them in the chat. My next one for the panel is, we've talked a lot about like the impact on the business, I guess, from the business point of view. I'd love to touch now on like, is there things that the founder or existing team need to be aware of, like in terms of what are the implications if I flip up? What impact does that have on the founder? What impact does it have on the existing team?
Great question. The first thing is that there can be really significant tax impacts for founders, especially. Particularly, they need to really make a decision about where they are going to be physically located. Are they going to be an Australian tax resident? Are they going to be a US tax resident? When do they need to become a US tax resident? What timing does that look like around the flip up, so that they don't have a capital gains tax exposure around that? And we've had some issues that have cropped up in the past where founders relocated too early and have become US tax residents before they do the flip up, and then that changes how the CGT is going to be treated for them. Other things that founders need to be aware of is how ESOPs are going to be dealt with, and how an ESOP in Australia differs to an ESOP in the US, and how they need to explain that to their employees. The upside is that, again, for the most part, the treatment at a tax level for the actual employees isn't a big deal. It's different, but it's not a big deal. But again, it's an explanation there. The final thing that I think founders really need to be aware of is just how much additional work there is going to be dealing with the US corporate structure compared to if, a very small Australian proprietary limited company. We have very few filings if you've got, 5 shareholders and you don't have a huge amount of revenue, and that sort of corporate governance corporate governance steps that you need to deal with in the US is just different. And while we all speak English, US law is a completely different language to how we operate here in Australia.
Yeah, well said. I was going to kind of reference the language more than anything else. I think that's the big change, and the thing that I probably coach founders who are coming at this from an Australian perspective and then shifting over to a US, talking about the fiduciary duties of the board members and kind of what does that mean? What types of decisions need to go through the board versus what is a management decision? Generally speaking, I'm advising founders that, like, if you're not sure, it's always in your best interest to get the board's approval, because otherwise you might expose yourself to personal kind of fiduciary duty liability to stockholders. But that's very much an overgeneralization. And then I do think there's an equity component to it. Look, I kind of wave my hands and say, hey, there are tax issues, but particularly as you're talking to US taxpayers, and particularly if a founder or a key team member is going to be in the US, being just high level familiar with things like qualified small business stock, which is I hesitate, it's not a loophole. It's a very intentional provision that basically allows for a massive tax savings for people who own qualified small business stock. It has to be a corporation. There's some requirements to kind of stay aligned with. But basically, your first $10 million in gains or more, now that there's been recent changes, are actually not taxed. You're not subject to US federal income tax as long as you hit certain thresholds. And so that is also one of the reasons why US-based investors might want you to flip in the first place, because if you're eligible and under the assets threshold, then the investors as well will be eligible for that tax treatment. And then similarly, I think it's kind of speaking the language on equity. Like Isaac said, there's not usually an immediate tax impact for the holders of that equity as long as everything's structured properly. But if, after the flip, if you're going to be hiring US-based employees who have worked at prior startups, like, they're going to have some very specific questions and come in very well informed, and will be wondering, do you have a 401(a) valuation? And if so, what was the fair market value of the common stock? Are you issuing options? Are you going to extend my post-termination exercise period? Can I early exercise the options? What is the vesting schedule? Concepts that, like, I'm not saying those are foreign to you by any means, but like I do see that, like, there does seem, particularly when you're hiring kind of like engineers, Silicon Valley types, like, you're going to get some very specific questions that are very specific to kind of US tax law and the way that an ESOP works for a US company.
And I think the last thing that we need to keep in mind is that the Australian company doesn't disappear. So whilst it becomes a wholly owned subsidiary in Australia, you still require an Australian resident director there. You must still comply with all of your obligations under the Corporations Act, under Australian tax law, etc. And the thing that we haven't spoken yet about, Cody, is where does the intellectual property sit, and how do we move that around? And should we be moving that intellectual property around? Should we be considering how that interacts with R&D tax incentives here in Australia, etc.? So there's a lot of, I suppose, landmines that a founder can step on that if they do the wrong thing or they take the wrong path, they will end up in a position where their company could be uninvestable or unexitable because the intellectual property is in the wrong place, or they can't use it, or they've created a tax problem because they've got a sandwich structure happening. And they need to tick the box, I think the phrase is, Cody. But there's so many things that they need to be aware of, and we cannot possibly answer that in 4 minutes on a call. So, yeah.
Yes, if nothing else, hopefully just the takeaway here is there's a lot can go wrong. It's kind of a measure twice, cut once approach. And yeah, I don't have an answer to the IP ownership question, but that's something where hopefully having good Australian accountants involved as well will be able to answer those questions and think through it. And yeah, for the primary goal here is like you want to have the multi-billion-dollar exit, and let's not make a mistake early on. They can kind of complicate that or just make it a lot more difficult than it needs to be in the future.
Yeah, and I think from our experience, while there are many things that become more complicated, sort of like the differences in corporate reporting and whatnot too, some things become more simple. So there's a bit of push and pull on that. And once you do get your head around the difference in the corporate governance of US, it's not impossible to follow and work with a good attorney to guide you through it. And it's not like you're going to a completely different legal system, in the EU or something necessarily. There's lots of similarities as well. It's just adjusting the way you do things, and a bit more crossing the T's and dotting the I's is the way I'd sort of explain it.
Yep.
All right, we've got another question in the Q&A box. It says, when flipping, we generally try to give shareholders an equivalent percentage interest in the US company. Are there situations where it isn't possible to replicate the same type of ownership? And how often does that affect whether the company can or should proceed with the flip?
Great question. Isaac, have you? Yeah.
Yeah. And from an Australian tax law perspective, you are really required to maintain those same respective proportions and interests through to the new US company. And the reason why is so that you can obtain the CGT rollover relief. If you can't obtain the CGT rollover relief, each shareholder who is an Australian tax resident will end up paying capital gains tax on that flip ups restructure. That is what I would consider to be a disastrous result generally, unless the company is worth nothing, in which case, who cares? It's sort of like, if the market value of the company is $0, then it's not an issue. But if the company is worth, 10, 15 million Australian dollars, you could have a very significant tax bill that needs to be paid in cash to the ATO in the relevant financial year. And this is not a cash generating transaction for your shareholders. So there's no liquidity there for them to pay that tax bill.
Somewhat tangentially to that, I would say I've seen scenarios where like investors might want to maintain existing rights that they had that are kind of like separate from the shares itself. And so usually you almost have to recreate the ownership they had. But for example, if there's some kind of side letter that has pro rata rights going forward, and this would be true whether we're doing a flip or not, there might be a negotiation there to say, hey, the lead investor is requiring that all these side letters get terminated in connection with the round. And like, those are just hard conversations that have to be had whether you're flipping or not. But sometimes there are just kind of ancillary things that need to be addressed at the same time.
I think for the most part, like it's not always the case, but for the most part, if you are flipping to the US, you've realized that it's worthwhile because you're going through a good round. You've got a good investor that's on board. So it's a success story for most investors. So you do have the leverage in that negotiation saying, hey, this is taking the company to the next level to really improve your prospects of success here. So most of the time, it's pretty well supported and you can use that as leverage.
Totally.
Excellent. All right. Well, we have 2 minutes to go, and I'm conscious, obviously, Cody, you've got a pressing meeting picking up your son from school, so I don't want to make it
7-year-old who will be yelling at me.
Yeah,
yes.
he's going to be yelling at you. But I do just want to, I guess, say first of all, thanks for all three of you being on the panel. Thanks to all the people that have given us an hour of their time this morning. Obviously, it's a topic that is pretty challenging to cover within an hour, but would love to have each of the panelists now just, I guess, give their like one liner or one key takeaway that you're hoping, all the CFOs, founders, operators that are on the call at the moment, what's like the one key thing that you'd leave them with?
Prepare early from me.
Yeah.
I'm
going to restate what I said kind of earlier, which is just like focus on building a really exciting business that people are excited to invest in while having key experts to make sure you're not totally going off the rails when it matters. So yeah, that prepare early is a better way of summarizing exactly that.
Yeah, I mean, I think we're in 100% agreement there. The most important thing is make sure everything's in one place. So I don't want to be sitting there trying chasing you down for copies of safe notes or where's your Excel spreadsheet of your cap table. Just put it in a Google Drive or something and make sure it's all in one place. It's really well labeled, every document signed. Make sure that your cap table's not sitting in an Excel spreadsheet. It does not work. The money that you spend on products like Cake is worth every cent when it comes to these sorts of projects.
Yeah, that reminded me, Isaac, too. I was just gonna make one plea. Please don't substitute AI, large language models for real legal advice, for real accounting, for real cap tables. I've just seen it go wrong so many times. Like it's worth it. Look, a lot of law firms, I don't want to speak for Isaac. I think it's a different model, but like firms like mine will defer fees and not expect to get paid until after these financing rounds close. And so don't let the kind of high cost of all this stuff scare you away. That if you're going to go raise money, you'll make it work. But please don't substitute ChatGPT for real legal advice.
Yeah, I mean, we're obviously happy to work on fees as well, Cody. So
I figured as much.
it's a business model, right? Like, we have
Yes,
to we have to operate that way. But yeah, just I agree. Yeah, the large language models, the AI, is just not. It is no substitute. Yeah, it can get you a little bit of the way, but it cannot give you that understanding that people who are doing this every day of the week can give you. And again, that last whoever said it earlier, get people who work together frequently. It will save you time and hassle in the long run.
Excellent. Thank you so much, everyone. We'll bounce now.